A healthy super balance can help you have the retirement lifestyle you really want when the time comes. But just relying on the contributions your employer puts into your super may not be enough. If you're in a position to add a little more, it can help you out in the long run, and there are some great tax benefits as well. There are so many great options to help boost your super, so we have divided this video into two parts. We'll start off by looking at some of the ways you can contribute to super, including a before tax option known as salary sacrifice. Then we will explain personal contributions, a strategy to use after-tax money to build your super. And importantly, we will discuss some of the rules and guidelines around making contributions to super, such as contributions caps. In part 2 of Boosting Your Super, you can learn more about government co-contributions, spouse contributions, downsizer contributions, the First Home Super Saver scheme, and the importance of financial advice. Don't worry if this all sounds very technical. We'll explain each option and the benefits for you and your super. One of the easiest ways to boost your super is through salary sacrificing. This is where you ask your employer to make extra super contributions into your account straight from your employment income before any tax is taken out. This is on top of the compulsory contributions they're already making for you. As well as saving more for your retirement, salary sacrificing can be tax effective, as money that goes into your super is generally taxed at only 15% rather than your marginal tax rate. How effective this strategy could be for you depends on your level of income and individual tax rate. Regardless of the potential tax benefits, every extra contribution you make to super will help grow your retirement wealth. Here's an example of the kind of difference just a small amount could make. Kim and Robin were colleagues. From age 40, they both earned a salary of $80,000 per year. Kim, who didn't salary sacrifice, ended up with a super balance of around $341,235 when she retired at age 65. Robin decided to salary sacrifice 2.5% of her income each year, which meant she had around $25 per week less take-home pay. But when she retired, her super balance was $397,859. That's $56,624 more than Kim. There's no minimum amount required for salary sacrificing, although there is a maximum you can contribute each year before you incur tax penalties. This is called the concessional contributions cap, and we'll talk more about that shortly. Another great way to boost your super is to make personal contributions using your after-tax income. These contributions are in addition to the compulsory super guarantee your employer makes on your behalf. There are two main types of personal contributions: non-concessional contributions and personal deductible contributions. Let's take a look at these options in a bit more detail. A non-concessional contribution is money you add to your super that you have already paid tax on. Using after-tax money means there's no contributions tax payable on this amount. Say you've received some extra cash, like a bonus, tax return, or inheritance. Or maybe your kids have finished school and you're no longer paying school fees. Or perhaps your mortgage is finally paid off. You can contribute up to $100,000 each year of after-tax money, as long as your total superannuation balance is less than $1.6 million on the previous 30 June. And from the 1st of July 2021, these thresholds will increase, which means you can contribute even more to help grow your super. Visit the ATO website and search Bring Forward Rule for further information on this option. The second category of personal contributions are personal deductible contributions. In this instance, you can add to your super using after-tax money, but you can also claim a tax deduction for this amount. This is considered a concessional contribution and is subject to contributions tax, which is generally 15% or 30% for higher income earners. The benefit of this type of contribution is that you may be able to reduce the amount of tax you pay by claiming a personal tax deduction. Your individual tax rate will determine how tax effective this could be for you. This option is available to a lot of people, It is often used by self-employed contractors and freelance workers who do not receive the compulsory super guarantee from an employer. It is also available to eligible employees who want to boost their super and reduce their tax. To claim a tax deduction on your personal super contribution, you must meet the ATO eligibility criteria, as well as notify your super fund of your intention to claim a tax deduction. Visit the ATO website to see if you are eligible and how these contributions may benefit you. It is important to remember that personal deductible contributions will count towards your concessional contributions cap that we mentioned earlier. Let's look at this in more detail now. The cap is a limit on the amount of concessional contributions you can add to your super each financial year without incurring tax penalties. The combined total of your concessional contributions, which includes your salary sacrifice contributions, employer's compulsory super guarantee contributions, and any personal contributions where a tax deduction has been claimed, can't exceed $25,000 per year. This amount will increase to $27,500 on the 1st of July 2021. Check the ATO website to find out more about the different types of concessional contributions. Whilst it's important to keep in mind the concessional contributions cap, there are some circumstances where you might be able to contribute above this amount. The Carry Forward Concessional Contributions Strategy, or more simply put, Catch-Up Concessional Contributions, allows you to put more into your super if you haven't reached the general concessional contributions cap in previous years. There may also be the added benefit of being able to save on tax. To take advantage of this option, your total superannuation balance must be less than $500,000 on the previous 30 June. Let's look at how this works. Zoe has taken time out of the workforce to care for her children and doesn't expect to return to work until 1 July 2021, when her total super balance will be about $50,000. Each financial year since 2018, Zoe was not employed and did not contribute to super. She is able to save her unused $25,000 cap each year. So, over 3 years, Zoe would have been eligible to contribute $75,000 into her super. When Zoe returns to work in July 2021, she can make a catch-up concessional contribution of up to $102,500 using the 2021-22 cap of $27,500, plus the $75,000 of unused amounts from the previous 3 years. Her catch-up may include personal deductible contributions, salary sacrifice contributions, or her employer's super guarantee contributions. Zoe is on a modest income, so she is not likely to contribute $102,500 in 1 year. It's important to remember that you can only accrue unused amounts since 1 July 2018, and catch-up contributions only apply for a 5-year period. For example, if Zoe doesn't use the $25,000 unused cap that she accrued in 2018-2019, by the end of 2023-2024, it won't be available in later years, because that will be outside of the 5-year window. The new higher threshold of $27,500 will only apply for catch-up contributions made after 1st July 2021. We have discussed a lot of information throughout this video. Each strategy is potentially a great way for you to boost your super, but it is important to remember that super is a long-term investment, and you will not be able to access it until you retire or meet a condition of release. There are also conditions and eligibility criteria that may apply, so it is worth visiting the ATO website for further information about this. If you are considering making an additional contribution to your super, we suggest speaking with a financial advisor who can review your personal situation and work out what is the best and most tax-effective option for you. A financial advisor can also help make sure your super is invested to suit your life stage and risk preference to get you on track to achieve the retirement you want. And to find out more ways to grow your super, watch Boosting Your Super Part 2. If you have any questions or would like more information about super, we're always here to help. Thanks for watching.